Hi, everybody.
Nice to see everybody.
Good to see you. This is our grand finale. It's been an incredible season with, so many amazing sessions. And this one, I'm just so excited about it because, it's just one of those topics. Just when I thought I got it and somebody will say something, I'm like, oh, no, I don't have it.
Yeah.
So I'm really excited to learn from the absolute experts that we were able to engage for this session. Mark Radcliffe from the LA Piper is our host, and of course, I've been going to Mark for what, 20 years now, seeking advice every time I try to do something. So I'm just delighted that we have him here with the expertise, and of course, Allison and Matthew, I'm gonna let you introduce yourself. They're absolutely the expert. Long before I can spell this whole space, the only places I heard was the blockchain capitals that Allison and Matthew were doing. So Allison, I'm gonna pass on to you for the introduction.
Great, Claudia, thanks so much. And it's fantastic to be here. It's a great turnout, and we think it's a really important topic. So really glad to be part of this. And Claudia asked us to ask Matthew and I to take sort of 10 or 15 minutes at the beginning of the session and demystify blockchain. So that's a pretty challenging task, but we're gonna give it a go. So I will just tell you a little bit about Matthew and I and sort of how we came to be so excited and focused on this space. And then I'll hand over to Matthew, who'll sort of attempt his quick and dirty demystification. And then I'll come back and just give a few minutes on why we think all of this matters to board directors. And as a person who serves on many boards, I think there's some sort of really important themes for directors. And then I will hand over to Mark, who's going to go deeper on some use cases, and we'll try and open this up for sort of discussion, dialogue back and forth as soon as possible. Because I think many of you on the phone actually have on the Zoom call have incredible expertise or perspectives on this topic too. So anyway, Matthew and I are married, and we have been investing in blockchain technologies since 2013. So fairly early days. Our firm is called, our investment firm is called Blockchain Co-Investors. So we are invested globally. We're the leading global diversified investor in this space. We back about 30 venture capital firms, all focused on blockchain technologies and the promising companies based on them. And then through them, we have exposure and positions in about 300 blockchain technology companies globally, in China, throughout Asia, throughout Europe, here in the US, Canada, etc. And we also do some direct investing, and we also invest in tokens. But so that's our firm, and we have a really good perspective on this whole area as a result of sort of for the last 8 years tracking the space and seeing who's doing what, and seeing what companies are emerging as leaders in the space. Tell you a little bit about how we got interested in this topic. Matthew and I, our careers, first half of our careers, for 15 years, we were in consulting. We worked for McKinsey for 9 years, and then Carney, and in Matthew's case also Booz, and we were partners leading the global financial services practice there. Matthew led the digital commerce and media practices, and so we worked with really the largest banks, the largest payment companies, large technology firms, and sort of saw firsthand what was going on with those. And then we both did stints as executives in big companies. Matthew was head of marketing and strategy at the Gap when Gap was moving into digital commerce and launching Gap Online. And I was the chief financial officer at Barclays Global Investors, which is now part of BlackRock, when we were launching all the iShares products. and institutional investing was sort of tipping into that space big time. And then we've been full-time in investing really for the last 10 years, but we started investing in early stage technologies when we moved out to the Bay Area in the mid 90s. We started to get incredibly enthusiastic about new technologies that were starting to change the world. And, you know, we worked at some of the bigger companies that were starting to, you know, launch online and go digital and mobile banking. And we started being angel investors in the space. And I would say we've just gotten more and more excited as we've seen the incredible transformative power of new technologies in the last 20 years and the massive value that's been created and the massive value that's been lost as well as that happened. And we think it's only just the beginning. We think we're in the very early stages of what we call the fifth era, and we've written a lot about that. And, you know, that's a broader topic for another day. But why are we so excited about blockchain? It's such a critical component of the next generation of our digital economy. And as Matthew is going to sort of walk you through, the current internet and digital economy has many, many flaws. It's not fit for purpose in the sort of next evolution of our digital world. And blockchain solves many, many of those problems and sort of a critical technology upon which to build from scratch many of the components of the next generation of our sort of digital lives here on the planet. So we think there's going to be massive value created and massive value lost as the new plumbing and infrastructure is all built, new use cases, and we are incredibly excited about it. So over to Matthew, who can sort of dive right in.
So thank you very much, Alison, and it's great to be here as well. And I see some familiar faces. As Alison says, I'm going to do the demystifying blockchain part, and then Alison's going to talk a little bit about specifically what should boards do and how should they respond. And then I know Mark is going to take us through some very interesting specific applications. So in the next 10 minutes, I'm going to not begin with blockchain. I'm actually going to begin with the last 30 years. So all of you are very senior executives, professionals, board directors, and you've lived through a time of unprecedented innovation and change. And all of the industries of the world, every business, every enterprise has changed very substantially in the last 30 years. And you know that, you know it, and you know that the companies that you represent a director of have themselves changed enormously. Now, for Alice and I, there are three main driving global innovations that have powered this last 30 years. The first is the internet and the movement towards a digital economy, which I'll come back to in a moment. The second is the life sciences revolution and the shift to personalized medicine around genetic and DNA sequencing and testing and CRISPR-9, etc. The third is the shift to a not carbon-less, but certainly not a carbon-dependent global economy. And that's really kicking off right now. But there's also a host of other innovations that are also just as fundamental and just as transformative. So we call this the fifth era. We're transitioning out of the industrial era. But the reason I've begun here is because you already understand that. You understand everything around the 30 years you've already lived through. Well, unfortunately, it's not completed. The digital economy of today is only half built. And the reason for this is that what we began with, which was the internet, is essentially a communication platform. TCP/IP, which is the protocol that sits underneath most of the World Wide Web, the internet of today, was intended to be a communication protocol. And it does that very well. And so for the last 20 to 30 years, we've used that feature, that set of features, which are communication features, to connect 4.5, 5 billion people, most of our devices. Many of our industries have become reliant upon that communication platform. And frankly, most of the businesses that you serve have been transformed in the process. But the problem is, because it was a communication protocol, it was never built to be a commerce platform. And in fact, TCP/IP is very bad as a commerce platform. And there are 5 specific things that are fundamental flaws with the internet that we have today. The first of them is its security. The professors and DARPA, MIT, Stanford, and so on that built TCP/IP trusted each other. They were communicating between academic institutions and others. They were sharing information, but they didn't believe that they were going to have secure solutions against hackers and phishers and breachers. And so TCP/IP is fundamentally an insecure protocol. And you see this every day. So most recently, we're beginning to see ransomware, where entire pipelines are being closed down. And of course, the press talks about the fact that the kidnappers, if you will, were paid by Bitcoin. But that's not the important point for you all to take away. The important point for you to take away is that the software upon which the largest pipeline in America runs is insecure. It's fundamentally insecure. And in fact, the bad actors are using technology to exponentially improve their ability to breach, to hack, and the like. So that's the first issue. The internet of today is insecure. The second is it has no inherent system of identity built into it. And the manifestation of this is not just the last mile problem where you don't know the individual that sits behind the device that is connected to the internet, but actually, to a large extent, we don't really know which device, and we certainly don't know whether the content that we are sharing is the content that was sent. So we have a system of global communication that is built upon an identity platform that may have made sense 30 years ago, but doesn't make sense today. The third issue is concentration. We do know that the internet and the value creation of today's internet has been increasingly concentrated in a few hands. They are the world's most valuable companies today, bar none. And the EU, the US, China, all major governments around the world are concerned about that concentration of economic value in a small number of companies' hands. But for blockchain, what's most important is today's internet has no native digital monies and no native digital assets. And so despite the fact that every one of your companies is involved in commerce, every one of your companies participates in payments and transactions, and every one of your companies has a balance sheet, and that balance sheet includes multiple types of assets on it, almost all of that is either paper-based or it is riding on infrastructure that was created to support a paper-based world. And this is why settlement times and costs and processes, even for public equities, are inherently slow, costly, and unable to do the types of transactions and settlements that we expect in a digital world. And I know a lot of you are on bank boards, some of you are on payment company boards, some of you are on boards of retailers and others. All of you are going to be dramatically impacted as we shift to native digital monies and native digital assets. And just to underline the assets point, we tend to think that public equities have been digitized. It is true at the version 1 level, but none of your companies actually know who your shareholders are because you work through proxies, and none of your companies can communicate to in real time to your shareholders, and none of your companies can do real-time compliance because even public equities is only at version 1 of digitization. Well, almost all the world's real estate, almost all of the world's funds, almost all of the world's private investments are still paper-based. They haven't even been digitized to version 1. So in that context, why does blockchain matter? And the reason is that this anonymous group or person, Satoshi Nakamoto, 10 years ago, tried to create the world's first at-scale digital cash, a native digital currency for a digital world. And in order to do that, they needed to create a protocol, the blockchain protocol, that could complement TCP/IP, the communication protocol, in solving the issues of security, identity, distributed, and in order to establish a digital money, and that is Bitcoin. So Bitcoin is important because it is the world's first native digital distributed money. It is a prototype for every digital money, including the digital dollar, the digital yuan, the digital euro, etc. But it also is conceptually a model of a real-time digital asset. And all the world's assets are in the process of being digitized. And 3 years ago, if I had said that, the world's largest banks and asset managers might have sat back and thrown rocks. Today, I can tell you after having spoken to them that every major exchange in the world, every major asset manager, every major bank is now fully on board with the fact that we will have digital monies and digital assets in a native internet-enabled way in the next 5 to 10 years. Well, why does that matter for all of you? It matters because you are all in commerce. Every business is a commercial enterprise. And as I said before, and I'm now wrapping up, that means that all of the payment infrastructure, all of the accounts payable and accounts receivable infrastructure, all of your balance sheet activities, all of the assets you hold, all of the commerce and transactions you do are going to shift to new infrastructure. And that is a bigger challenge than year 2000. That is a bigger challenge than the initial rollout of the internet, because the internet was about communications and you could bolt it on. But the transition to digital monies and assets is about changing the core infrastructure of every business in the world, especially all of the financially focused businesses of the world. And then just to nail this coffin firmly shut, the other reason you cannot afford to ignore this is the native digital citizens of the world are now becoming the majority. They are now in their early 40s. They are digital first, they are mobile first, and they expect all of their products and services to be delivered to them in real time, low cost, digital first approaches. And unfortunately, for some, they will put their money towards those companies that serve them in the way they want to be served. And they are accumulating wealth, and they're moving into their power years, not only do they have the most disposable income to spend in many businesses, but they are also moving into positions of power, because as they go into their mid and late 40s, they increasingly will be the regulators, they will be the congressmen and women, they will be the leaders of the world, and they will transition the world to a native digital platform. And businesses that want to resist that will lose. And with that, I think I've probably said enough. I hope that helps you put blockchain in a broader context. And I hope that hints at why it's so important that today's boards and directors begin to focus on the issue. But now I'm going to hand over to Allison, who's going to get a bit more pointed and specific about how directors can help their companies transition. So over to you, Allison.
Okay, thanks, Matthew. So just briefly back to the role of the board. And you know, I serve on the boards of many sort of legacy large companies that are dealing with disruption in their industries. And I also served on the board of VC-backed scaling unicorns that are going public. So it's really interesting to sort of be on both sides of this equation. So I have just a few quick points to make. One is there's some research we think is really, really important that we mentioned, go into detail in one of our books, but it looks at why companies fail, the lessons of lost value. And it researched sort of in the 21st century, why do businesses fail? And if you then compare that with the things boards focus on, right? Boards spend a lot of time on, operational issues. How are we doing this, this quarter, this year with our operational plan? They focus a lot on compliance. 81% of the times companies fail, public companies fail, is strategic and innovation blunders. So what that means is someone else in their industry had a better product service than them. Competitors sort of came and took customers away from them. They didn't spot an innovation trend quickly enough. And, so I think ultimately this whole issue of strategy is very much obviously at the board, one of the board's most important responsibilities. And even to date, we've seen massive value created and massive value lost in most industries. I mean, I've seen that. I serve on the board of Fiserv, which is a $70 billion market cap payments company. And almost since I've been on the board, we've seen Stripe come from nowhere to have a $95 billion valuation. We've seen Square come from nowhere to have a $117 billion valuation. In the last few years, we've seen companies like Affirm come from nowhere to have a $17 billion market cap valuation. And, these are all, the speed of these is only going to get faster. As we said, we think we're in the really early stages of the fifth era. Blockchain and other new technologies are coming along, and it could not be more important for the board to own this issue of long-term strategy and sustainability. One interesting thing is a lot of boards think strategy needs to be owned by management, which of course it does. But the average tenure of a CEO, or the median tenure of a CEO in the US, in a US public company, is I think 5 years. So if you're looking 10, 15 years out, the likelihood is that, the board will be managing succession programs. And you can't just hope that the next new CEO that comes in will, start from scratch to worry about the strategy. So I think boards play a really, really important role on strategy and long-term sustainable strategy. And remember, over 80% of the time companies fail or lose value. It's all about strategy and innovation, and that's only going to increase. And then, I could talk at length about this, but I think it's very important for the board to pick CEOs who are fit for future purpose. This is not a time in many industries that are being disrupted to have leaders and C-suites who are really good at operations and block and tackling and turnarounds. And it's hard to find those leaders who are sort of steeped in new technologies, understand how quickly value can be built, and are up for that challenge. Obviously the diversity of the skills on the board is important. There are many, many other things, but one other that I'll mention is strategic planning approaches are incredibly outdated and not fit for purpose in a time of uncertainty and such rapid change. I think it's really important for the board to ask management to have a future view, to lay out emerging trends, new technologies, disruptors that affect their business, and how those things could play out in the next 5 to 7 years. What different scenarios might be if those trends move faster or slower, and what the implications are for the company. I think it's a very, very important conversation for a board to have with leadership team. And it's not about management presenting a strategy. It's about laying out a future view and what could and what might happen, and best case and worst case, and beginning to engage around what the company should and could do proactively and defensively. And then, finally, supporting management in sort of taking some risk. I mean, the biggest risk in times like this is not taking risk, sort of focusing on what's right in front of you and sort of keeping operating, focusing on operational challenges ahead of you and not thinking ahead. So it's really important for boards to require management to have a future view, to engage a lot of external voices in that table. Let yourself be challenged by experts and people who are disrupting you, and partners in the ecosystem who have a view of your strengths and weaknesses, and encourage them to be frank. And I think there are always incredible lessons learned from that, but many boards are quite internally focused when you look at how time is spent. So anyway, those are just a few thoughts about how this all rolls up for boards. And blockchain technology, as Matthew's laid out, is critically important. There are 5, 6, 7 other equally important developments in the world we live in, and the role of the board on strategy in the future and creating a sustainable strategy to create value, not destroy value, could be more important.
Thank you very much, Allison and Matthew. I'm going to pick it up now. I'm just for people who are not familiar with DLA Piper. DLA Piper is a global law firm in over 40 countries with over 4,200 lawyers. And frankly, we're quite focused on innovation because we made a bet on the future, and we thought the future was global. And there are various strategies a law firm can have, but one of the most important we thought was global. And if imitation is the greatest form of flattery, a number of our colleagues have now come to that conclusion too. My practice is a mix of intellectual property and corporate securities. I'm based in Silicon Valley. I've done about 1,000 venture deals, and I run our corporate venture capital practice. So I sit between the large companies and small companies. I and my team generally work with about 40 startups at any one time. I've been to about 105 board meetings in the last 3 years. And unfortunately, I don't get to go to the board meetings for my clients where everything's fine. They've exceeded their targets by 20%. I tend to go to the ones that say, well, we're going to fire our CEO and we're running out of money in 6 weeks. So those are the type of board meetings I attend. But I also have actually served on outside boards. I was on the board of a New York Stock Exchange company that focused on innovation. And right now I'm on the board of a publicly traded closed-end mutual fund, which invests solely in late-stage venture. And so we actually have to provide a net asset value for the fund every day. For about 80% of our assets are illiquid. We're holding about 60 stocks. We have about $500 million under management, so about $500 million. So I've seen both the point of view of boards, both from as a lawyer and as well as actually serving on boards. And I think what Allison said is incredibly important. I think that we're in a time of incredible disruption. I've been doing this for over 30 years. I don't think I've ever seen the disruption going as broadly and as swiftly as we're seeing now. And blockchain is certainly a very important element of that. I thought Matthew did a great job of putting that in context, because the technology itself is, interesting, but I think its potential effect is going to be, frankly, more important than the internet, which I hope Matthew would agree with that, because I do think that people frequently refer to it as monetizing the internet, which I think is absolutely correct. And I also run our corporate venture capital practice. That's how I met Claudia, and that's another element in strategies for companies. There are now over 1,600 companies that are investing in startups, but I think that's got to be part of a larger innovation strategy. We call it one tool in the innovation toolbox. So as people think about their role on the board, I think it is important to think about the future and think about innovation, because, as I mentioned earlier, the scope, breadth, and speed of innovation is unlike anything I've seen, even during the dot-com boom. So let me shift over to blockchain and talk a little bit about some of the opportunities there. So there's a recent PricewaterhouseCoopers study that estimated that blockchain would add 1.76 trillion to the global GDP by 2030. I think that's really a little bit of an underestimate, but like all 9-year estimates, you have to be cautious about it. What I think is interesting is where they saw the opportunities. And the first and largest, $962 billion, was provenance, which is a fancy word for saying supply chains. And as a matter of fact, I was speaking to the Association of Ball Bearing Manufacturers on this point, because I didn't realize it before I spoke with them, but ball bearings are having a lot of problems with counterfeits, which I think is a problem across many industries. And the things that you sometimes don't want to know are that there's a lot of counterfeits that are going into airplanes. So when you're flying, you should hope that blockchain will help reduce the number of counterfeits to zero as far as plane parts go. Payments and finance, which I think Matthew mentioned, and Allison also mentioned, is going to be a big issue at $433 billion. Then identity at $224 billion. I mean, think about our current identity with driver's licenses and how subject to fraud that is. And then contracts and discounts, and then customer engagement coming in at sub 100 billion. But I think particularly any company that is consumer facing has got to really think seriously about a blockchain strategy, particularly an NFT strategy. We're working with a number of sports teams that are trying to decide how do they digitize their offerings, because for those of you who are sports fans, you'll know that many of you may have scrapbooks of your tickets or your programs and stuff. Obviously, that's all now digital. NFTs offer you the opportunity to recreate that experience digitally and actually go beyond that. For example, you could have an NFT that acts as your ticket, and then if you come to the to the stadium early, say, oh, why don't you get a discount on a T-shirt, or why don't you get access? You want to pay and buy another NFT, or get access to a special green room, or things like that. So everybody who is in sports and in entertainment is thinking about these matters. There's also, and this will be in materials that get distributed later, a chart from McKinsey talking about how blockchain is going to affect various industries with varying degrees of impact. And I think financial services and entertainment are two of the ones that are going to be most impacted. But everyone has a supply chain, and I think those supply chains, as we've discovered during COVID, are very fragile. And I think blockchain offers an opportunity to make that resolution. I will say, as important as blockchain is, it's not a silver bullet. It doesn't solve all problems, and certainly the technology now is somewhat immature. And so you shouldn't just assume that blockchain will solve every problem that you have, but it does solve problems, particularly ones that don't have a good solution now. Some of it, once again, in the deck you'll be seeing, there's a chart about the sorts of problems where blockchain can be most effective. For example, is there a requirement for verification? Are there multiple stakeholders that are involved? For example, I'm working on a blockchain consortium for major oil companies that's going to track trading of oil and natural gas. And then, is this a business where they say they cross trust boundaries? In other words, different players, people outside of a single company. And are there intermediaries that can be removed? I think that's particularly challenging for people in the financial services business. But when you also, there was a very good report by BCG talking about what they see as the four basic types of opportunities. One is new business models. For example, I mentioned NFTs and sports teams. The NBA put up a trading platform for NFTs. There's in October, soft launch in August, but they've had over $250 million in trades. It's a little difficult to tell how much the NBA has made, but they basically think of these NBA moments, which are basically 15 or 30-second videos dressed up in a sort of a digital framework that has are sold and traded like baseball cards. And these are videos that you could get on YouTube for free. So that's a new opportunity. And then you've got operational efficiencies. The ball bearing manufacturers were very interested in that because of the challenges in their logistics supply chain, risk mitigation, once again, particularly in the area of fraud, and then social impact, tracking things like blood diamonds and things like that. So let me go now to some of the, I'd say some of the use cases that are in existence or will soon be in existence. So many people may have heard about the Walmart leafy greens blockchain. So basically what happened was there was a problem with salmonella on lettuce. They were able to track it, but using the methods at the time, they tracked it back to a county in Arizona. That county had over 15 manufacturers of lettuce. And so basically they pulled all the lettuce from that county. They couldn't tell where it came from. With Walmart thought that was very expensive. And so what they did is they required all of their suppliers of leafy greens to use blockchain developed by IBM to track them. And they were said, they went from a couple of days to identify where the contaminated lettuce came from to basically a matter of an hour or 2 hours, and they were able to go directly to the farm. So they're very efficient for them. And I think we're going to see that, frankly, in, throughout the food world as we come to recognize how much for fraud there is in food. Something like 40% of the fish that you eat is not actually what it's advertised to be on the menu. So that's one area that I think where we're going to see an increasing amount of use. Then there's the anti-counterfeiting. Honeywell has developed something called Go Direct Trade for airplane parts. Many airplanes use, or the airplane parts are something that's been used and refurbished, and they come with a lot of paperwork, but sometimes the paperwork, shall we say, has been altered, and sometimes it's very difficult to get the paperwork. So they started that a couple of years ago. I'm going to do a little bit of a deeper dive there because that's a real, business-oriented use case. Amazon Web Services has now started its own airplane parts trading system. There's a system for basically storing files inexpensively. It's called the interplanetary file system, where basically people are paid to make their hard drives available. And then you have another group called Helium, which basically encourages people to put up Wi-Fi hotspots. And those Wi-Fi hotspots are, funded, well, not funded, but you're encouraged to do this through earning rewards through a token program. And they're used primarily to extend Wi-Fi coverage very inexpensively for Internet of Things, and including things like micromobility. So Lime has their scooters, and they need to know where the scooters are, and to do it using cellular is quite pricey. So they've teamed up with Helium to use Wi-Fi. And then I mentioned non-fungible tokens and what's going on there with NBA Top Shots. But also, I'm representing a company called IPWE, which is using non-fungible tokens to identify patents. It turns out that who is the owner of a patent can be very complex. You have over 180 countries that issue patents. Some of those countries don't have great record keeping. Even in the US, people fail to make the appropriate changes. So having non-fungible tokens can help you do that. And they're also developing ways for people to monetize their patents, not through being a patent troll and suing people, but rather by banding together like MPEG and basically getting all the relevant patents that are major new technology and making them available all from one source, which can encourage people to adopt new technologies. And we're working on something right now in the consumer space that has to do with QR codes that give you a lot of data. And then in the world of consumer goods, there's one of the major top whiskey manufacturers is developing a virtual world called a metaverse, where they're going to have a virtual distillery, and you can take a tour and then you can get a token. The token will allow you to buy some scotch. So that sounds like something to be very interesting. I'd like for to have a virtual winery myself. But sports teams are being very active. Juventus has a jersey, which is signed by all the team members, which they're putting up as an NFT, and then the NFT is linked to that particular object. And so I do think one area where there's going to be a lot of activity is NFTs linked to real world items. There's already a company called Materium that is using this once again to prevent counterfeiting, but in the toy space. So collectibles for Star Wars is where they've started, but there are many other potential use cases there. And we're also seeing some sort of funny oddities. For example, there's a Dionysius bag from Gucci where the bag in the real world costs $300–400, and the virtual bag was sold on a platform called Robex for $4,100. So the virtual bag was more, more valuable than the real bag. Just talking a little bit about the Honeywell Go Direct Trade, I think that gives an example of how swiftly these types of markets can accelerate. So this is built on a Hyperledger blockchain. It comes from the Linux Foundation. They had 4 million in sales in the first 10 weeks. In 2020, about a year after they founded it, Boeing added $1 billion of parts onto it. So this is not just Honeywell selling its own parts, it's everybody in the industry selling their parts. The most recent numbers they have are 9,500 users, 3,200 companies, 200,000 monthly page views. And then when you go to, well, okay, how do I know the part that I'm buying on this is the part that it claims to be? Well, that's still a work in progress. Right now we're making that transition from paper to digital that Matthew mentioned. But just to give an example of the digital native approach to this, Honeywell, basically for all of its parts, they have two-factor authentication. They laser etch something called a data matrix from iTrace onto it. They then put 2 different types of security inks on it. And then they have an app where you can basically take a picture of it and confirm that this is the part that it claims to be. And they actually do that etching and everything else, immediately when it comes off the assembly line. So it comes off the assembly line and it gets immediately added to the blockchain, so it's there. So I think this is a tremendous opportunity for companies. And also, I think, as Matthew said, you can't stand still. That's really not a choice. So that being said, I do think that people need to understand that blockchain is still a young technology. There's a lot of people out there. We've gone from essentially 2 what are called layer 1 blockchains in Bitcoin and Ethereum to an explosion. I actually serve on the governing council for Hedera Hashgraph, which is not actually a blockchain. It's distributed ledger technology, but has sort of the same functionality, and it's actually designed for business and enterprise. So, this is clearly something I think you need to consider, and particularly if you're consumer facing, I think you really need to have an NFT strategy, because that's a potentially enormous revenue stream, and there are a lot of people out there, and if you don't take advantage of it, they will. So that's the end of my presentation. I think we're going to shift over to the panel discussion. I noticed we do have some questions, and I'm going to raise the questions for the panel, and we'll see. So first question was, Allison, this is a question for you. What is Horizon 2 to Horizon 3?
Yeah, I think there was a great suggestion on the chat about a good book to read on this, where boards of directors, management teams, it's a framework for strategic planning, Horizon 1, Horizon 2, and Horizon 3, where Horizon 3 is sort of further out there, much more uncertainty. Horizon 1 is more near term, etc. So I totally agree. That's it's a good framework for strategy discussions. I think a lot of companies, and I'm involved in some of them, are still sort of using 10-year-old, 3 to 5 year strategy approaches, where they take 6 to 9 months to do the strategy. They come up with something, they present it to their board, gets approved. It's nowhere near taking enough account of new technologies, disruption, sort of ongoing trends that could dramatically affect them. So I think I agree that that's a good framework among many others.
Yeah, I think the name of the book is Alchemy of Growth. Is that correct?
Yeah, and McKinsey commonly is using that framework with clients on, innovation strategy, and all strategy these days, needs to take account of incredible innovation forces.
So there's another question about whether or not blockchain technology could be too intrusive and basically, stepping in on the toes of business confidentiality and transactions which people want to keep confidential. I don't know if Matthew, maybe it looks like that's something you might be responsible to. So.
Well, yes, I'm happy to talk about that. I'm a former Booz partner, and you'll remember that Snowden worked for Booz for a while. So let's be clear about this. This is not a blockchain question. This is a societal question. The US government today can monitor all communications of all citizens in real time, as can the Chinese government. And in fact, the American government is quite capable at monitoring the communications of the government leaders of every other country in the world in real time, and does do so. So privacy is a societal question. Technology is a double-edged sword, and new technologies can certainly upset the apple cart with regards to things like privacy and identity and so on. I don't view that as anything very specific about blockchain. The question that this often comes up with as regards blockchain is to do with the degree that information is public. And so to explain this, let me just also say that blockchain is just software. And when we design software, we have design choices. Those choices could be, for example, how secure is it? How immutable is it? How public is it? How easy is it to access and share? With the Bitcoin blockchain, those dials were set to 10, all of them. So it is the most secure, the most immutable, the most transparent, the most public. And in order to get the software to meet all of those parameters, it also consumes a lot of computing power, which turns into energy usage too. But those were design choices. So Mark talked about Hedera hash graph. So Hedera hash graph, and it's a strange name. They have their design parameters set in a different place. So going back to the question of privacy, a fully public, transparent blockchain is not a very good device for maintaining privacy. And so if you're thinking about corporate applications of blockchain, you're probably going to modify the design parameters. You're going to say, well, we want it to be less public and less transparent. And so you're going to end up designing a slightly different blockchain. But you can do that. This is just software. And in that sense, it's a choice. So taking it from the top, the questions around privacy are societal questions. We are in the middle of global dialogue around how much privacy do we want in business, commerce, and in our own private lives. Blockchain can increase transparency, but it can also protect privacy depending upon what type of blockchain you choose to use. And at the level of the business you represent, those are going to be design choices you're going to have to make regardless of whether you use blockchain or not.
That's absolutely. I'm sorry. Go ahead. Finish your thought, Matt. Sure.
Well, the only final thought was the only choice you can't make is to have breachable, hackable information solutions, and all of your businesses are being hacked every day today. Target was hacked. Yahoo was hacked. You know, you are bleeding information and privacy every day because all of your businesses are riding on mainframe-based software solutions that are not fit for purpose in the coming age. So you have no choice but to upgrade all of your technology. It's an inevitability. Sorry, Mark, you wanted to say something.
No, I was going to say it's not just a choice in the blockchain you choose, and in many cases, I think public blockchains are not going to be what companies use, because for the reasons you mentioned, the settings are not what they want, but also the design of the system. So I represent a company called Velocity, which is trying to use blockchain to make it easier to follow people's work history. And the design choice they made there was that none of people's personal information would be on the blockchain. The personal information would remain on their device, would be transmitted directly to the potential employer, and the person could control what information went to the potential employer, and there'd be a hash on the blockchain to confirm that that information was correct. So so there's both the design level at the layer 1 level, but there's also the architectural level. So and I agree. I think it's important to recognize how problematic our current situation is, because sometimes people compare blockchain to some perfect IT system which doesn't exist on the planet, and so it's a matter of choices of how much risk you're willing to take. So, yeah. So what is the best way for a director to initiate discussion on potential impact of blockchain on their company when management is not bringing it up? So.
Yeah, I think, well, it's back to this point that, I do think you often hear in some boards a sense that it's, management own strategy. And once again, given the sort of succession issues with CEOs, I fully falls to the board. But I think, something for the board to discuss in private session, and for the chairman to, put it on the table as a board agenda topic, perhaps inviting, that the board can invite third parties in to give them a view of what the challenges are. The board can ask management to put this topic on the board agenda. The board can call a special meeting for, as long as it likes, to thoroughly sort of kick the tires on new technologies and how they affect the company. So I think the board has immense power and authority, and actually responsibility, with fiduciary responsibility, to get these issues on the table.
And if I could add to that, Allison, Allison and I wrote a couple of books, that one of which you'll get for free after this from the NACD, which is on blockchain competitive advantage. But the other book was on corporate innovation. And the right way to engage your management team and board is not with the technology. So you shouldn't even be talking really about blockchain any more than you should talk about TCP/IP. You begin it with the customer and competitors. And so, going back to the dot-com boom, I was the head of strategy and corp dev for Gap. And we had fundamental challenges in the business, such as when most people walk into a Gap store, there was a pretty good chance that we would be out of stock on the specific SKU they wanted, the product, the color, the size, especially if you were an odd size. If you were like me, most of the time, we wouldn't be in stock on your size. So we realized that having Gap online, gap.com, gave us the opportunity to be always in stock and a couple of days away. And that was a breakthrough. So we launched gap.com, and we quickly became the world's largest specialty retailer online. Of course, Amazon came by and blew us out of the water. But the point is, it began with a customer insight. What is the customer need that they are experiencing today that your company always bangs its head against, that these new emerging innovations can solve? And then the other one is competitive, which is to say, if you're in the automotive industry, you had to be blind not to notice that Tesla was building out a global rapid recharging network. And they've been doing it for years, and you didn't begin, right? So they now have a massive barrier of entry on electronic vehicle charging globally. And how many automotive companies will ever be able to catch up? Because how many rapid charging networks will the physical world support? It won't be 20. So that's the second vector. The second vector is look at the competitors in your industry, watch how they're applying these innovations, and then ask yourself the question, is there a risk here that they've seen something we haven't? And I think, Alison and I would argue that as a board, if you ask your executive team to constantly look at the unmet consumer needs and constantly be paranoid of competitors doing things that you're not. In that mix, you will see the applications of technology and innovation that are worth pursuing first. And I know about 6 of you are on bank boards. Well, there is a reason why the world's biggest banks are now wholeheartedly driving against blockchain and digital monies and assets. And there's 10,000 banks in the world, and about 9,950 of them have not even begun to think about what the big banks are about to do to them. And the same is true in asset management, the same is true in payments. So this is not, the world's most sophisticated competitors are now firmly on board with what this, this central thesis.
Yeah, by the way, I think Iris made a great point in the chat that, it's starting with one technology, also this is a broader issue of what new technologies and innovations out there have impact for our company or could in the future, and what are competitors doing. And I think one of the things we did, I chaired the Technology and Innovation Committee at Royal Bank of Scotland for many years, and we asked every function and every business on a regular basis to come and talk to us, and that was their topic. We said, tell us how new technologies out there, how you're thinking about new technologies and how they could, improve the audit function. How are you using them in the marketing function? How are you using big data and, new technologies in the finance function? We also had the businesses come and, talk about the same topic. So we were curious, and we asked the question very often. Another thing we did at RBS, the board asked the management team, we said, we're curious. We'd love to hear some scenarios and assumptions about, over the next 3-5 years, how new technologies, disruptive new players could take share away from us in different pieces of our business. And the CFO went off and led that and got input from his team, the strategy team, some outside consulting firms, some outside technology providers. And they were all different assumptions. And then he laid out, look, the worst case assumptions are disastrous for us. The best case assumptions are really troubling for us. The in the middle case assumption, it finally created a set of options and scenarios for everybody to look at. And it was crystal clear that, you can't start presenting hockey stick projections for your businesses anymore, given this broad set of assumptions, where the best case is still very, very troubling. So it just started, it started an important dialogue. So I think that it's not just about blockchain, it's about innovation, new technologies and disruptions happening and looking out beyond the next year or two.
Yeah.
Yeah, and there's a question about, are blockchain and regulation incompatible? They actually use the term oxymoron, which I have to use 3 times this month to keep from my vocabulary, so I'll use oxymoron. I think the answer to that is no, they aren't. But they are it sometimes can be very difficult to apply them. And, probably the most pointed example of that is in financial services, where many of the regulators depend on intermediaries to ensure, that AML and KYC and avoid terrorist financing, things like that. In the blockchain world, where there's a lot of peer-to-peer activity, those type of regulations are very difficult to apply, which I think is one of the reasons, frankly, that the SEC is struggling with how do we regulate this, because it clearly does need to be regulated. All you have to do is, look at some of the things that have happened in the past with the Dogecoin, basically, which is it started as a joke coin. It's now literally worth billions of dollars because Elon Musk is tweeting about it. And also, so there's a lot of great opportunities and projects in the blockchain space. And there's a fair number of fraudsters too, which I think is not unusual for a new technology. If you go back, the center of serial development was in Michigan. And when you got off the train, there would be people hawking various new cereals to you, and the opportunity to invest in these new cereal companies This is back in the 1890s. So that, so we see this, I think, in every set of new technologies. You just have to be prepared for the fact that it's a bit of a challenge. And I think, the regulators, I think eventually will get it right, but it's also true that you need to engage with them. I think the best example of people not engaging appropriately is Facebook and Libra. I was representing an investor there. They completely blew their opportunity there because they didn't engage with the regulators and they were arrogant. But in this type of space, it's really important to bring the regulators on side, or even take the Uber strategy, which is ask for forgiveness, not for permission. But in highly regulated industries like the banking industry, forgiveness is rarely granted. So I think that's a bad strategy. So.
Hey, Mark, if I can just add to what you're saying, I think you made some very important points. But having worked, I worked for 10 years buying and selling banks and worked very closely with the Federal Reserve, the OCC, the FDIC, all the banking regulators. I think we completely, as you said, we welcome regulation in this space, and it's coming fast. Regulators are more knowledgeable every year. Federal Reserve and others are starting to do research on the future implications. Do we even need banks anymore? Central bank digital currencies. I mean, there's growing awareness and understanding, but one thing by the regulators, but one thing I will say is the regulators they're trying to keep us safe and secure. And the problem with the bank's current infrastructure and technology is that it's incredibly cumbersome to do AML, all the new privacy regulations, all the things that regulators are appropriately focused on are very challenging to do given legacy financial services technology. And, built in the cloud, modern digital businesses using blockchain and others are much more able to comply with important regulations. So it's actually another case for the coming of blockchain.
Yep. I'd like to inject a slightly different thought here, which is I don't think any of you or your boards or your teams or your companies should fall into the trap of being binomial. There's the past, there's the future, there's clicks or there's mortar, there's non-blockchain or blockchain. That is not helpful. And that mindset tends to encourage established businesses and companies to drop back to the legacy and to protect what they've got. I think you do better to think about spectrums of change. So I'll give you an example. We had mainframe computing, proprietary mainframe computing. Then we had connected mainframe computing. Then we had outsourced mainframe computing. Then we went to the cloud. Now we're moving to decentralized cloud, and we may move to distributed decentralized cloud, okay? Or another example would be, we used to have paper-based money, then we had plastic money, then we had the first generation electronic money. Now we're going to true digital cash, and then we'll be going into digital wallets and real-time global digital currencies. These are spectrums, and the reason why spectrums are more helpful is that teams can deal with incremental change, but they tend to get paralyzed by disruptive change. And your challenge for most of you, not all of you, but most of you, unfortunately, are on the boards of old companies. And so your challenge is you've got to get an old company with a lot of legacy to try and move forward. So you do better to do it by setting up this challenge as a challenge of incrementalism, rather than scaring them to put their heads into the ground. And I saw that at Gap, by the way. Most of the Gap people, 450,000 of them, didn't believe electronic commerce would ever happen. And we were able to show them through a process of incrementalism how it could be beneficial. So anyway, I want to just give you that thought. Don't turn this into a binomial, yes, it's blockchain, or no, it isn't. That isn't going to be helpful.
I totally agree with that. I think it's important to identify the business problem and then look at technologies, because as I said, blockchain is not a silver bullet. For example, there are many database functions inside a company where blockchain would be too slow and too expensive and not worth, it's wonderfully, immutable, and, it has all these other characteristics which are not needed for an internal blockchain. And when you're also, also just to add to this issue, incrementalism versus, disruptive, sometimes you need to just, get the disruptive change out of the organization. When Netflix, Netflix started out as the people that mailed you CDs. They had to take their streaming division and put it in a separate building, because otherwise the guys who were still mailing CDs would have strangled it in the grid. So sometimes you just need to have physical separation.
This is Claudia. One thing that I want to say as we approach the end of our time is we are all in for a huge tree. Aside from the couple of things that Matthew mentioned, Bill, Mark, Matthew, and Allison have prepared a fairly comprehensive deck of charts that really reflects so many points that has been brought up through their individual talk and through the Q&A. And of course, we will be, Lisa, Haley, the team will be sending all that out with just a tremendous, when I saw, I just thought, whoa, this is incredible stuff. So you will get that, and also all the reference materials that you will see for further learning on the blockchain and the blockchain competitiveness, and all the wonderful books that these two has authored. So we decided not to bring that into the session, so we can allow a more interactive discussion with the directors. We now have really just a few minutes left. I know there's more questions in the inbox that we can address in the next few minutes, but I thought this would be probably a good time to ask Allison, Matthew, and Mark just sort of the wrap-up statement for us to walk away from this session. Allison, should we start with you?
Yeah, sure. Well, I think as we've been saying, our view is blockchain technology was an incredible breakthrough, and has huge implications for the next generation of our digital economy, and massive new companies will be created around these use cases. And the legacy companies of the past actually have have many advantages to create these, to take advantage of these, white space opportunities, right? They usually have good cash flow, they have customers, they have data, they have regulatory relationships, they have talented people. And so it's sort of theirs to lose in many ways, right? Versus 4 guys who just left school, in a basement with a good idea, trying to connect to VCs. And there are some large, legacy companies that are really leaning into an innovation strategy around these things, and looking at how they can benefit, but it requires you to take your eye off all the hard work of sort of moving the deck chairs around on the Titanic. That's a bit, of a strong term, but so many of the companies we all know are incredibly distracted and focused on, the re-engineering, the transformation, the technology stack modernization, the cost takeout, all of that. And I think a big lesson learned from those companies that are great at innovation is that they balance doing some of all that work with making bets and placing resources on the future. And they build muscle over time, and they get good at starting and incubating and launching new businesses. And it often is with partners, not just internally. So anyway, I think this is a really important time for boards to help their companies be the winners in this whole landscape, and not the losers. But it's hard, and it takes a lot of work.
That is so true. The ambidextrous leader, right, which took a foreigner a lot of time to learn the word. Thank you, Matthew.
So I was trying to turn off my virtual background. 30 years ago, 35 years ago, when I was a new McKinsey analyst, I would never have imagined that today I would be speaking to 80 board directors from a park bench in the park on San Juan Island off the shore of Seattle. That would not have been conceivable to me. And so the question for you as board directors is, how much different will your companies be in another 15 to 20 years? And I'm now 60 or 59, as Allison always reminds me. So are my eyes the right eyes to see that future? Because I couldn't see it before. I think that the thing to do right now is to try and get into the behind the eyes of your own children, who are quite possibly 30-year-old, 20-year-old digital natives, and see the world as they see it and see the world that they want. And then ask yourself the question, is your company fit for purpose to deliver what they expect and what they will have? And that's where blockchain is so important, because if you talk to the digital natives, there is no uncertainty about this. They want digital monies, digital assets, real-time digital access. They want blockchain and blockchain-enabled solutions. They want decentralized, distributed ways of doing things, and they will have them. They will have them. And I think they'll have them a lot sooner than we imagine, just like we have global real-time video streaming today, and I never guessed we would have had that 30 years ago. Over to you, Mark.
Yes, Mark. Last but not least, also our host and sponsor, Mark. Go ahead.
Thank you very much. So I completely agree that the pace of acceleration is basically moving in a much more quickly than I've seen it in 30 years sitting in Silicon Valley. And I guess, the other point, which I'm sure that people recognize, is that the economy is now global. I mean, when I started out, startups would go to the US and say, well, we'll work on the US market, and then, in a year we'll go to Europe, and then in 2 years we'll go to Asia. Now they're basically international immediately. So that's important. But, as you think about the future, I do think it's important to recognize that one way of viewing it is science fiction. I actually love reading science fiction, but cyberspace actually came from science fiction. And if any of you have seen the movie or read the book Ready Player One, that talks about a metaverse, an entirely digital universe with avatars and everything else. We're already seeing that. So if you want to look at the future, science fiction is actually a good way of doing it. And there are actually companies that pay people to read science fiction so they can try to see the future. But I agree that we're, 10 years from now, it's going to be very, very different from what we have now. I will say that people are going to want functions, and they're not going to, they don't necessarily want to have, I want to have digital money from blockchain. They're going to have digital money. They don't care if it's blockchain behind it or some other technology that comes along. So as important as blockchain is, and I do think it's a fundamental technology, I think the recognition is start with the business problem, look at your technology options, and decide what's going to work.
This is fantastic. Thank you, everybody, and thank you for everyone who signed on. This has just been an incredible, insightful session for us to continue to learn about it. So have a great rest of the day, everybody. Thank you so much.